Would you be tempted by a company offering you a yield over 6%, but with showing payout ratio over 100%? Today, we're going to talk about Enbridge and how this crazy dividend is the end of the party, or you're going to continue to get paid nicely. Dividend investors, bonjour. My name is Mike Ihu, and I am the founder of Dividend Stocks Rock. I'm also a passionate investor that hosts this YouTube channel to help you invest with more conviction so you can enjoy your retirement. So if it's your first time here, just give me a thumbs up, subscribe to the channel. Every Thursday morning, we have a new video. Last week, we talked about BCE payout ratio that was over 100%. The yield was around 5%. And then we kind of dig further to know if the dividend was safe. And actually, the company is good and is able to increase its payout by 4, 5, 6% every single year without any problem. But now we're going to take a look at a different company in a different sector. High yield, 6% for Enbridge. And in finance, there's no free lunch. So is the party's about to crash and you're going to get stuck with capital loss and a loss of income? Or is Enbridge dividend is safe? This question, I'll answer that in a moment. But first, let's take a look at the business model. Overall, Enbridge, one of the largest pipeline company on North America. Everybody knows it, especially if you're in the oil and gas business. So we're talking about almost 4 million customers, a lot of gas and oil transmission. And as you can see on this graph, you have plenty of pipelines going all kinds of direction. What I particularly enjoy about this model is its diversification. They have a lot of source of cash flow. They have a lot of clients, and pipelines are usually take or pay system, meaning that Enbridge signs contract averaging about 25 years long, so very stable in terms of income source. And on top of it, they tell their client, you know what, if you use the pipeline, you're going to pay that much. But if you don't use it, you're still going to pay a minimum fee to kind of your place reserve in the pipes. Long story short, if the oil and gas industry goes up or goes down, it doesn't affect much Enbridge revenue because they're based on long-term contract, and regardless if their customers needs the pipeline or not, they still have to pay for that cash flow. As you can see, most of it is liquid pipeline, which are oil, and then you have some gas transmission, a little bit of this distribution in storage, and a new source of income just came in with renewable power. They used to have renewable source of energy several years ago. They sold it to invest more in their oil and gas business, their oil and gas pipeline, and now they're going back kind of reverse, and we're going to talk about that a little bit longer. The thing about Enbridge, while it pays a high yield, it has been able to increase its dividend for 27 consecutive years. So Enbridge is one of the most generous and most stable dividend grower in Canada. So you get all excited and you're just thinking, wow, stable business model, long time dividend growth history, great yield, pretty much the retiree's dream, right? And then you look at the payout ratios and you realize that the regular payout ratio as we know it, dividend divided by the earnings, are over 100%, so 115 right now, but it has been over 100% for a very long time. So you dig a little bit further and you say, well, we're going to look at the cash payout ratio. We did that with Bell, and this time it's even worse. We're at 850%. So this means the company really didn't have any money left to pay that dividend and will likely have to go into more debt and dig a bigger hole to satisfy their shareholders' appetite for income. I've done more research on that topic because Enbridge is a very popular company. A lot of investors are super interested in investing in this great generous source of income, but yet there's that like income created by the high payout ratio. So when you dig further, you realize that Enbridge is actually using the distributable cash flow payout ratio, so commonly called DCF. To calculate the DCF, it's not a GAAP number, so it's not accepted by general accounting rules. Unfortunately, it is pretty much a homemade type of, like we do that on a napkin type of thing. Calculation, because we have to consider that pipelines are capital intensive, similar to Bell in my previous video, where I explained that the company is investing massively in its infrastructure. It's pretty much the same thing with pipelines. They have to invest in their pipelines maintenance, and they have to invest in new projects if they want to create new income streams. That kills the payout ratio and kills the cash payout ratio. So this is why you have to go with the distributable cash flow payout ratio. So let's take a look at the investor's website. This is what I usually like to do. So either look in the financial statements or the investor's presentation. In this one, Enbridge always has this nice chart, like all the information is there, and you can see that the DCF per share was for 1.23 in 2021 in the last quarter of the year, and for the full year we're at $4.96. So $4.96. If you look at the current dividend payment is 86 cents a share. Times 4, you get $3.44 per share in dividend paid every single year. So assuming that DCF will not move, and actually kind of funny because management expects to see some growth, but we're going to talk about that in a moment, the current payout ratio would be 69%, which gives more than enough room for the company to finance their project and continue their dividend growth policy. So this is how this business has been able to increase its dividend for the past 27 years, even though their payout ratio numbers are completely through the roof. Full disclaimer, I do have Enbridge in my portfolio. I treat it as a deluxe bond, pretty much a company where I don't expect much stock price appreciation, but I do appreciate the yield. I bought it a couple of years ago when there was a lot of turmoil around line 3 and line 5. That was a good timing, turned out to be a pretty good investment. Now I'm getting a very nice yield on top of that of my purchase, and the increase should continue moving forward. When we look at investors presentation and investors day, we're going to see how the company intends to grow their business. So as I mentioned earlier, the future dividend for this year will be $3.44 per share at the end of the year, and the company expects DCF to increase by 5 to 7%. So while they're increasing now the dividend by 3-4% a year, they still expect to have their DCF per share increase mid-single to high single digit, which is a very good news. If you go a little bit further and you see, okay, so what's going to really happen here? Well, then you have the outlook through the next 3 years. There's a lot of revenue coming from other projects. They're going to invest massively in renewable as well, and this is how you're going to get that 5 to 7% EPS increase, DCF per share increase. Looking at the organic growth, well, the world needs more energy, and if it needs more energy, well, obviously you need to transport that, and then you need to store it. So this is why they expect a lot of organic growth just by demand, saying, you know what, we need those pipelines, we need those transmission lines and those storage facilities, and Enbridge will just be able to benefit from that. I know there's a risk with regulators, especially with new projects. Enbridge has been has been used to deal with governors and senators and doing all that politics to make their pipelines construction happen. I don't think it's gonna change in the future. They're going to face more hurdle, but in the end, unfortunately, we need oil, we need natural gas, and Enbridge is one of the best company to provide it to us. So it would be a little bit of hypocrite to not consider that we need this type of energy. We're not in the renewable transition complete yet, so we'll have to be a little bit more patient on that side. Speaking of renewable, the company has various projects. I think that this is something that will be a good sign for this company and a good point in general. A lot of investors wants to get more ESG investing. If Enbridge can switch part of its business model towards renewable energy, it will be also a very good news for the market in general. Personally, I can only be for renewable energy, obviously, but this is how the company intends to grow. So they will have organic growth for the demand for oil and gas, but they will also invest massively in renewables. I think it's still early in the game. We need a lot more energy in the coming years, especially with the arrival of more EVs and the shift of power as we want to less depend on fossil fuels, on carbon, and so on. So in general, I'm very happy with my shares of Enbridge. The dividend is more than safe. Actually, it's not only safe, it will increase in the upcoming years. But if you are worried as interest rates is rising and inflation is still very tough for consumers, if you fear that we're going to go into a recession, I do have a complete workbook to help you build and manage your portfolio during tough times. We're going to have a new edition shortly, so you just have to click on the link below, download the ebook, and if you download it by giving me your email address, and I'm not going to spam you, that's for sure, you're going to get the updated version. We're already working on it. It's going to come up in May of 2022. Actually, every year around May and June, we're going to update this workbook. You're going to find plenty of questions to help you think about your investing strategy, maybe see things that you haven't seen yet or considered in terms of potential downsides and risks that you have in your portfolio. And it is pretty much a hiking guide to help you throughout your investment journey. So I hope that you have enjoyed this video. Let me know in the comments what you think about Enbridge. Would you prefer TC Energy? I'm kind of like curious about this one. Do you prefer another pipeline business? Let me know in the comment. And until the next video next week, don't forget to stay invested.